Let's talk markets for a bit and where Wall Street could be headed. Andrew Sheets, research strategist at Morgan Stanley. Good morning to you. We went on quite a run, Andrew. It was quite a run, and now we are in what seems like a pullback of sorts. The question is, how far back does the train return? Where are you on all this?
So we're defensive in our positioning. We generally think across the U.S. and European markets that high-grade bonds will outperform equities. We're a little bit more optimistic in some of the emerging markets and in Japan. But I think you're absolutely right. We've had an incredible run of markets. It's been great for holders of equities. But that run has been entirely about valuation expansion. And especially, I think, given where that is compressed valuations between stocks and bonds, and with concern that earnings growth will continue to slow, we see pretty poor risk reward for U.S. and European equities here.
Across the board, that means for those who play the indexes, S&P, NASDAQ, broadly, or even industry indexes, you wouldn't even do it. Are there specific stocks or places you do like in the U.S.?
So there are specific places, and generally we think some of the more defensive sectors do look more attractive, and I'm sure we'll talk about the recent yield move, but we generally think that yield move has been overdone. We think that yields will move modestly lower over the coming months, and that should be somewhat supportive for the more defensive parts of the market. But I do think you have a challenge where that re-rating has been pretty broad-based, and our concerns around earnings pressure are relatively broad-based. That creates some challenge. There are obviously places below the surface for stock picking, and we do think some of those more defensive sectors outperform. But at the index level, we think the risk reward isn't particularly attractive.
You think you're a credit guy at this point. You like bonds.
We do, and we think that the bond market can benefit from a couple of factors. You have seen an enormous rise of real interest rates, the increased risk premium over expected inflation in the bond market. We think we're in a seasonally pretty good time of the year where bonds tend to do quite well in August, September. And we think there's still a lot of signs that even if a soft landing is achieved, even if a recession is avoided, which is our base case at Morgan Stanley, the growth data is still going to decelerate, and that could help bonds. And maybe one more factor is we think that the Fed has made its last rate hike for the cycle. We don't expect another rate hike in September, and usually bonds, high-grade bonds, investment-grade credit does relatively well after that last Fed hike.
You said you like Europe. We've just been debating what's going on in Italy this morning as it relates to the banks and what looks like a massive windfall tax. It's something we have not seen here in the United States before. Is that something that concerns you about other parts of Europe or even parts of Italy?
Well, I think actually the biggest concern around Europe is this is a region that's had an incredible run. In dollar terms, depending on the day, European equities have been up more than the S&P 500, as impressive as that S&P 500 performance has been, and yet I think kind of the soft landing story, which has been the dominant story in the U.S., and I think the correct story, given how strong the U.S. data has been, that really doesn't apply to the European data. The European data has been much, much weaker than the U.S. data. And so I think there is a little bit of a risk that Europe's been riding the coattails of the U.S., been riding the coattails of the U.S. soft landing narrative, when the underlying economic data is much softer, and then you could throw in some of the idiosyncratic risk, the country-specific risks like we saw today out of Italy.